Imagine waking up tomorrow and realizing that almost all the money you use was never printed by the government. Not coins, not notes, numbers, typed into existence. That sounds dramatic. It is also normal, and it matters right now because inflation, debt, housing, and job security all connect back to this one quiet mechanism most people never see. Here is the uncomfortable truth. Governments do not create most of the money in modern economies. Private banks do. When you hear money creation, you probably imagine central banks firing up printing presses. That does happen, but it is not where most money comes from anymore. Most money is born when someone takes a loan. Picture a bank approving a mortgage. The bank does not move existing money from someone else's account. It simply creates a new deposit in your name, on a screen with keystrokes. That deposit is new money. The loan is new debt. They appear at the same time. No pile of savings needed, no vaults emptied. This system is called fractional reserve banking, but the name is boring compared to what it actually does. It allows banks to expand the money supply every time they believe a loan will be repaid. That belief is the real engine. Here is where it gets strange. When you repay the loan, the money disappears. It is destroyed, but the interest does not disappear. It moves to the bank. So the system constantly creates money as debt, then demands more money than was created to be paid back. That gap is filled by new loans, new debt, again and again. This is not a conspiracy. It is how the incentives are wired. Banks are rewarded for expanding credit. Economies are measured by growth. Governments rely on borrowing to function, and asset prices, especially housing and stocks, rise fastest where credit flows most freely. Now contrast this with the story we are usually told. We are told inflation is about supply shocks or consumer demand or wages rising too fast. Sometimes that is true, but underneath there is a deeper driver. Money enters the economy through banks, not evenly, not neutrally. It enters through mortgages, corporate loans, financial markets. That is why asset owners often feel richer during inflation while wage earners feel squeezed. The money reaches them later, if at all. Here is the irony. The system is praised for stability, yet it depends on perpetual expansion. Credit must keep growing, or the structure tightens. Defaults rise, markets panic, governments step in. Every crisis looks different on the surface, but the plumbing underneath is the same. This does not mean banks are villains or that money creation is evil. It means power sits in places most people never vote on and rarely question. Long term, this raises uncomfortable risks, higher debt loads, fragile financial cycles, an economy where access to credit quietly decides who moves forward and who falls behind. And it leaves one unresolved question hanging in the air. If money is created as debt by private institutions in pursuit of profit, who is the system really designed to serve when growth finally slows?